We are here at the table with the doctor, Jason Heller.
Hello, hello.
Welcome back, man.
Hey, how's it going? How's it going? Good to see you.
Going good?
Yeah.
Yeah.
I haven't done this in a while.
What bias are we talking about today?
So we're going to talk about mental accounting today. So mental accounting is the idea that people will treat dollars differently based off of where they've come from or where they've been placed.
So meaning where your income came from, if you got a random check or something like that, versus maybe in your paycheck. And then when you say placed, what do you mean placed?
So people will put money in certain areas. So a savings account, a checking account, they're different, right? You put money in your investment account versus your checking account, you'll have a different view on how to treat that money, even though theoretically money is fungible, meaning it's all the same. A dollar's a dollar, no matter where you place it, no matter where it came from.
Yep.
But by placing it in different areas, you mentally account for its value in a different way.
Got it. So like I put it in a savings account at a bank I forgot about. All of a sudden I see a statement and there's, an extra $5,000 there I didn't expect. And then you're like, whoa, I forgot about this. This is like extra money. You'll spend that $5,000 differently than you would elsewhere.
So the classic example is a tax refund.
Yep.
Right? So you get a tax refund at the end of the year. Let's use your example, $5,000. A lot of people will go and spend that money in a frivolous manner, way more frivolously than they would if they earned that money through their paycheck and received it. So again, the idea is money's fungible, right? $5,000 that you just got back from the government, that's still your money. The idea that you can spend it more frivolously because it didn't come from hard work and getting it through your paycheck and saving it is ridiculous.
Kind of like when if you're gambling or you're at the casinos and you end up going up a couple $1,000, you're like, oh, I got a couple $1,000 to lose. But if you had to actually work for those few $1,000, you would never just say, oh, I want to go spend it ridiculously or just worry about blowing it before I leave a table.
So that's the other really good example, right? So let's say you do, so theoretically, if you do go gambling, whatever you bring in to play with, you should be comfortable losing, right? But once you do go up, if you're lucky enough, so say you're playing blackjack, you start with $1,000, now all of a sudden you have $3,000. You'll see people will start betting in significantly higher amounts because they've got money to burn at this stage. It's still $3,000, right? The idea they treat that money. I don't want to say this because it's going to sound awful, less respectfully than they would if they earned $3,000 out of their own paycheck.
My father would tell this to me about gambling. He's like, you got to keep betting the same amounts no matter how much you go up. Don't go betting bigger afterwards because that was a bet you were comfortable with.
You're either chasing, because you're down and trying to get back to even, or you're playing with money that is
I found that all that makes it is just I lose the money slower. I still lose it all.
By betting the same?
Yeah.
Sounds about right. Yeah, that's true.
So it's called mental accounting. Why is it that individuals decide to look at money differently like that? And as you've seen it with clients and working with clients, how do you see this play into them making poor decisions with their money?
So like a lot of the biases that we've talked about before, this one is a two-way street in that there are some positives that come with mental accounting. There's some negatives that come with mental accounting. So negatively, when people hold dollars as sacred, and I'll give you a good example. They put money into a savings account. It's in a savings account, low yielding, until recently when the Fed moved interest rates up, but low yielding. They won't touch that money despite having significant credit card debt at really high interest rates. The smart play, the efficient play, is to take that money that's yielding nothing, pay off those high interest credit card debt, and you're in a better financial position.
So if you're getting 3% in a savings account or 5% in a savings account, and you're paying 17% on a credit card, why would you want to be paying 17% interest when you have money getting 5% interest? Your better return is paying off that credit card, but they don't want to see their savings go down.
Exactly. The other one is, and I'll be first to tell you I'm guilty of this. You ever have the Christmas fund or the change account, in your closet, right? So I used to do this thing. It's really stupid. I used to do this thing where when I would come home, if there was a 1 or a 5 in my wallet, I would take it out and I would throw it in a shoebox. And over years, that money would accumulate, and I'd go on vacation with it or something like that. But that money would sit in that shoebox for years before it accumulated enough to go on a decent vacation. That could have been even in a savings account earning something at that point in time, but I never took it out of the shoebox because to me that was vacation money and I wasn't going to do that.
Right.
Inefficient, irrational behavior, right? So there's the negatives. The positives come with placement, right? So you put money into your investment account or your 401k or something that's got a purpose behind it. You're less likely to spend it on anything except for that purpose, right? I'm less likely to raid my investment account or my kids' 529 plans or my 401k account for anything other than what it was set out to do. So there's kind of pluses and minuses. It's a two-way street, like a lot of the biases we talk about.
Yep, that makes sense to me. And so if you're sitting there as an investor and you want to try to make sure you're not having one of these biases affect you and start making poor decisions, and you don't want this mental accountant to say, okay, this bucket's for this or this bucket's for that, how do you become aware enough, or what questions you should be asking yourself to make sure that you're not allowing that to make you make poor decisions?
So ever since I stopped doing the shoebox $1, $5 deal, what got me out of doing that was asking myself, is this the most efficient use of these dollars? Now, the answer was no. Sitting money in a shoebox is not efficient. It's stupid. So what I didn't stop doing that, but what I did was I would transfer those dollars into a savings account. At the end of the week or the end of the month or whatever it was. I mean, I still kind of do it, but now I'm actually earning something on that. So you have to ask yourself, is what I'm doing right now the most efficient use of these dollars? And if the answer is no, you're caught up in that bias and you should reframe how you do things.
Yeah, and you can even use it in a positive sense, though, too. If you know that mental accounting actually works, so for example, I think the retirement accounts are a good example. People don't want to touch their 401k or their Roth. They know that that's already set aside with that. How can you be able to use that same concept with mental accounting? So it might be a matter of, all right, I'm going to open up this savings account in another bank, and that savings account is for my next home or the vacation home I want.
Yep.
And you have a certain amount of dollars that goes there every month when your dollar cost averaging over to there on a monthly basis. Then you know that money at this bank is my house money. And then you know not to touch that, and you kind of work it in your favor to do that, than opposed to in your savings account that you could tap into that you might see all the time in that app. It's actually money that you don't see that's kind of put somewhere else away from you.
So I do exactly that. So I have an online bank account. I'm not going to say the name of the bank, but I have an online bank account. They do this thing called bucketing, where they understand this bias, and so they actually help you with it. And so you can create theoretical buckets inside of your account and say, this is for my taxes, this is for my property insurance, this is for my vacation. And you can direct, when you deposit money or they deposit interest into that account, you can direct which bucket it goes to. And when emergencies pop up or opportunities pop up, I'm less likely to go and raid any of those other accounts because I know that they're set aside for a reason. I know if I've got money set aside for my quarterly taxes, I'm no more than 90 days away from having to fork that money over. So I'm less likely to go and do that. If it was all in one pool in my checking account, I can't say that I wouldn't be more apt to pull that money and go to take that opportunity.
No, I love that. I love the idea they're using technology almost to gamify how you're managing your savings.
Yeah.
I think the harder part goes that tax refund example where when you get money you don't expect, and we see this a lot with clients with inheritances. Obviously, you see it with lottery winners where they spend the money right away on something and they end up in the same financial situation 3, 5, 7 years later. What might be a mindset shift that somebody would need so they don't have that to happen, where they got extra money they didn't expect, or maybe it was a check, from something they overpaid and they got an extra couple thousand back and they didn't expect it and they want to go spend it somewhere else because it was free money.
Right. So the lottery winner thing is a really difficult thing because those people, they don't end up in the same financial position they were 3 to 5 years later. They end up in a much worse financial situation because they had all the money in the world, they blew it all, and now they got debts and they filed bankruptcy. It's ridiculous. But the found money situation, the tax return, there's an extra $1,000. I got $1,100 tax refund the other day. I had no idea what it was for, but it was totally unexpected. I'm not going to say no to it. I think we pay enough in taxes as it is. I was happy to get it. Yeah. But I actually had to fight with myself, knowing what I know. I still had to say to myself, all right, don't go piss this away. Let's go put this to better use. And so I think the idea is you have to almost fight against whatever base emotional reaction you're going to have to that found money, and go back to the concept of fungibility. And it's a funny word, but it's the idea that a dollar is a dollar. Doesn't matter where it came from or how it was earned or where it's placed. It's still a dollar. And so, if you're in order to have good financial sense, it doesn't matter that you have found money as opposed to earned money. It's still money, and you have to treat it as such.
Yeah, and I think that's probably a good note to end on, is the fact that a dollar is a dollar, and you have to treat all new money you have coming in is money you worked for and earned. And just because you didn't work for that money, that dollar is still the same dollar you worked for that you want towards your goals. And that should be separated as you would your income. If you save 30% of what you make or 50% of what you make, then do the exact same thing there, and then spend the other money how you would typically spend it.
That's a great idea.
Yep. So, mental accounting, hopefully you can realize how to identify it, what it is, and how to be able to change your approach when you realize you could be doing either positively or negatively.
Subscribe on your favorite streaming platform if you haven't already, and don't forget to share this podcast with your friends and family.